Good morning, SMF MMT at 6:05 a.m. 7:13 monthly options expiration and play. We're going to talk about this gap open up on the Nasdaq comp. We're going to talk about the trade management. We're going to talk about the volatility within the actual bull rally. We are in the third week of the following or the past 2 weeks. We still remain where the bull rally and the indexes had pulled back. They've hit a support level. You've had Italy contagion fear. Then, of course, you have your normal U.S. government contagion. So, basically, when we get into options expiration week, as we have done in all of our prior training sessions, is that we do know that even with the pullback and the bull rally, that the put to call ratio is still imbalanced no matter what. When you get into a monthly options expiration, not the weekly ones, I'm talking about the calendar monthly, that is the third Friday of every month, is that, as I said, Monday and Tuesday when we were doing, Monday when we were doing the big gap down, all of these things were pulling back because individual equities had ran too far too fast, and they have pulled back, and that the options expiration is going to create a lot more volatility in price action. The gaps that you see here today, because we're in a full-fledged earnings season and it's the first week, today's trade management will be the following. When the Netflixes, the Googles were selling down, the Apples were selling down, Amazon had a couple of upgrades on Monday and Tuesday. It didn't matter. They took that thing clear down to 211. 23 is where it closed. You got a $2 gap. Today, we'll look to see exactly how that thing will pull back to those support levels on Amazon and come down. They're going to make their high. They're going to pull back. Then we're going to look at how to get long. Okay? The gaps that you see from the previous couple of days selling is that on that gap, they will also inflate the call options. They'll sell those calls up there at the high. Then we're going to see what happens to equities and the volume and the price volatility at the upper resistance levels, where we would be looking for a distribution bar. So what we would be looking for is that when you make the intraday high, you would be looking for a big red bar that would start next to that last green bar. And the thing, MMTs, that you're learning is that the sell bar, the distribution bar, the profit taking bar, is going to be bigger than the last up bar. One of the things that we would be looking for at those upper resistance levels is that fat bar, the negative bar where they slide the bid, where that's where the short comes in, is it's 2 times greater in value than the previous up bar. Okay? We will look for the overall consolidation ranges. The bull rally, summer bull rally, is still in play. The contagion fears are out there. But when we get into this monthly options expiration, everything is put on hold. Doesn't matter what the U.S. is doing. Doesn't matter about Italy's debt. Doesn't matter about Portugal. Doesn't matter about Ireland. Doesn't matter about any of that. It's all about super price action volatility. One of the things that we have discovered and been doing quite correctly is that every time they get up there at that high, up at that other resistance level, the buyer is not there, and the short comes into play. Period. One of the things that you've been learning that the public is not aware of is about high volume frequency trading by artificial controlled pricing environments. Artificial means that they're done by supercomputers and whatnot, and you've been learning how to do that. So when we get up here on the gap open, because the super hyperactivity, and we have Ben Bernanke on the street today, is that when we get up there, we look for that reversal bar, and if it reverses like a 369 and then you get a green bar next to it and it comes up to the lower high. The key is on that retracement to the lower high or the higher low is that you're looking for that distribution bar that comes in right away. When the buyers are absent up there at that upper end of resistance, then that short need would be transacted for what it will give you, and the platform will tell you that. So that's the gap open up. That's going to be your trade management. You've got an options volatility. We have it on record. We'll take a look at the gap open down. We only have one stock. Now, remember on Monday during pre-market, this list here was as long as long. Earnings season, JP Morgan's going to report tomorrow morning before the opening bell. Rick Goley, go ahead and put those contracts out there today at a nickel and see if you get hit. Okay? JP Morgan, $42 call. Okay? That's exactly right. So, basically, you listen. Individual equities will look at their overbought processes up there at that resistance level where the buyer is absent. That will support that short trade for a reversal with a profit and say I've been given a gift.